and happy Wednesday, June 3rd. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. Going to the markets today, they are near session highs, driven a large part by a basket full of technology stocks. The Dow is in the 26,000 range, which is the highest we've seen it since the March lows, and the other indices are trending upward as well. So again, the thought there from some analysts in the market really are focused more on some technology stocks that are leading the charge there, so to speak. Going over to the crude oil futures, nice to see them remaining in the $36 a barrel range on futures. And kind of exciting news, the U.S. 10-year Treasury Yield is moving up. Not exciting from the sense of a lending point of view, because that can, over time, if it continues, affect the long-term permanent mortgage rates, make them higher. But right now, we're seeing a U.S. 10-year Treasury Yield at 75 basis points. So we're well above the 60 range, and that was a pretty big move from yesterday. So something to keep an eye out on. Jumping over to the FHA rates, we are seeing a little bit of an uptick there. Nothing too significant, but we're quoting the 223F fixed 35-year rate today at 251. That is 2.51 fixed for 35 years. And the 221 D4 rate fixed for 40 years, quoting that at 316 today. That is 3.16. Agencies, the GSEs remaining flat today. So we're looking at a 315 on the Fannie Mae DUS product and a 320 on Freddie Mac. Speaking of the GSEs, something I wanted to bring up, there was an article put out because there has been rules submitted by the Federal Housing Finance Agency, the FHFA, that are talking about removing Fannie Mae and Freddie Mac from government conservatorship, which is where they were put during the last Great Recession. So there are some proposals out allowing them to build capital on their balance sheets. I don't know if you know, but their capital has been being swept out to the U.S. government. So allowing them to build up their capital, much like a bank's balance sheet would operate. Talk to some folks. I don't think there's going to be any major moves here until after the presidential election, but something to keep an eye on. Not sure how that'll affect their pricing if and when that does occur, but it is certainly something we're going to report on here. Next thing I want to talk with you about today, I was speaking with a developer developing in a resort market. And it got me thinking, there are resort or quasi-resort markets. I'm in Colorado, but they're all over the place, where you've got amenities and attractions, and maybe you do have some growth, some overall year-round employment growth. Historically, these markets have been pretty difficult to build in because of the cost. Speaking with this one builder, we're in a fairly high-cost market, not compared to the coastal markets, but it could cost about $400,000 a door to build in the mountains. That is not cheap, and that's actually more expensive than some of the suburban areas in and around Denver. So that's fairly expensive. So one of the solutions that's being proposed, again, is modular. We've heard a lot about this. I've sized some deals and analyzed some deals. I haven't found one that has completely made sense yet, but if you do have one that makes sense where you're able to get your equity investment for the whatever down payment is required and get the modular units sent to your site, wow, you could really save some costs. This guy was saying they were building actual buildings, modular buildings, in a day. And they had 9 buildings. So in 10 days, they completed their entire construction project of the buildings. That's incredible. So if there's options like that, think about opportunities in marketplaces like that. The other factor that might be leading towards potentially more employment and more long-term housing opportunities in those types of markets are the fact that we are all somewhat in this new normal with working from home, and that is anticipated to continue. A lot of the leading companies that are coming on CNBC and some of the shows and speaking about this, such as Zoom and some of the other ones, Zillow was another one, they're really thinking that going forward, there is going to be much more of a robust work from home environment. If that's the case, wow, if you're an avid skier or an avid, hang glider, I don't know, whatever you like to do, there might be more opportunities to live in those smaller, amenity-rich but smaller places that have resorts and opportunities for recreation where you might not have thought of them as much in the past as viable because of employment and the need to commute to more of an urban market in order to have that employment. Something to think about. I was really blown away by the speed of the modular assembly. That is incredible. So think about that. Look at those markets in your area. Again, this is a time for development to really get your numbers out, start penciling stuff, and go make some land acquisitions. I'm going to end today's episode on that note. Thank you for tuning in. This has been another edition of Rate Desk with your host, Michael Thomas, signing off.